How is it that even though we're in the middle of a pandemic, unemployment rates are at all-time highs, small businesses are shutting down, and yet the stock market is still going up? Stay with me and you'll find out. About 4 million US businesses closed in 2020, according to Oxford Information Technology. And yet, the stock market is ending 2020 at record highs. The S&P 500 index is finishing the year up more than 16%. The Dow Jones Industrial Average gained 7.25%, and the Nasdaq gained 43.6%. Not to mention, the Dow and S&P 500 finished at record levels despite the public health and economic crises. So what's going on? Shouldn't the stock market be affected by everything going on around it? First off, let's talk about what largely drove the gains. Similar to what happened in the dot-com era, a handful of superstar stocks are driving the markets up. 3 of the biggest tech giants, Apple, Amazon, and Microsoft, accounted for more than half of the S&P 500's return this year. If you remove the top 24 companies from the S&P 500, which are dominated by tech and digital services, then the S&P's return would have been negative in 2020. How come the tech industry is doing so well? Partly because the stay-at-home environment is favoring the services and products that these companies are offering. The issue, though, is that this market is too speculative and too dependent on high-tech stocks. Another reason the stock market is trending up can be attributed to the vaccines being released. Investment markets are considered forward-looking indicators, which means that investors buy and sell stocks based on their expectations for the future. Right now, investors are looking ahead at a positive future. They're starting to see a light at the end of the tunnel. Analysts are saying that stocks are priced for perfection in 2021, but that means any deviation from that rosy scenario could lead to a rapid correction. And the third reason driving the market up is low interest rates. The US Federal Reserve has signaled that interest rates will remain close to zero for another 3 years. What does that have to do with anything? First, let's look at who owns the biggest stake in the stock market. More than 80% of all US stocks are owned by the richest 10% US households, so the vast majority of stocks is held by the wealthy. Now, usually rich people invest in bonds because they want to preserve their wealth rather than risk it. But now, treasury bonds are yielding very low interest rates, pushing the wealthy to look somewhere else for a higher return. So what do? They look to either invest in the real estate market or the stock market. That's why the Fed's actions have triggered a home buying boom, and why the stock prices keep going up. They're being disproportionately influenced by a much smaller subset of the population. So, is the market the same as the economy? I'd say not, as we can see from what is happening today, with the major indices at record highs, and the economic outlook not looking that great. The two do have a complicated relationship and can affect each other, but they're not the same thing. If you think otherwise, let me know in the comments below. Thanks for watching. If you enjoyed the video, please hit the like button. If you'd like to see more, subscribe to the channel. See you next time, and have a great day.